Hello, everybody. Happy Friday. Welcome to the TraderMerlin Show. Cheers. It is going to be a great show today. Just real quick shout out to my friend Pat who brought over this. It's the Crown Royal Special Reserve. Never even seen this one before, but you know what? Given the closing out of some of my crypto positions, enjoying a nice glass of very expensive whiskey today. Hope you're all doing fantastic. I'm going to keep the short opening here because we want to get to our guest today. He's got a tight clock. He's just juggling kids and going all over the place. So I've got 25 minutes with someone who's been on Power Trading Radio before. For those of you who are on the Trading Academy graduates, you know him and love him. We've got Mr. Sean Reed joining us from sunny California today. Sean, how are you doing?
Good. Can't complain too much. Just like I said, busy with kids and life. That's all I got.
That's a good thing to be busy with, you know. It's better than being busy with attorneys and all kinds of other nasty stuff. So good.
I'll give you that. Yeah.
Yeah,
sure.
Glad to have you with us, my friend. Just for those that might not know you, let's do a real quick little Cliff Note version of your background, who you are. I like to call it the trader profile piece. So tell us a little bit about yourself.
My pleasure. Well, hopefully I don't look like it in the face, but I've been in the industry, for over 20 years at this point. And I've worn a lot of hats. I actually, was in finance and banking, walked away from that to be a prop trader, started door knocking. I know Merlin and I share a very common background. Merlin was started as a prop trader as well. So the parallels are kind of fun. But yeah, no, I started as a firm capital or proprietary trader. And I did that for a number of years. They kind of tapped me on the shoulder. They said, hey, kid, we like what you do. Are you willing to work with people, train, trade yourself, and then run a trading floor? So I actually had my own trading floor at a young, wee age and in Scottsdale. And I had 25 guys and gals underneath me. And it was a long, strange, wild ride. It was super fun. And, we had a pretty fun trading floor. For me, I just got tired of the regulation side of it because we had to essentially try to somehow keep and rein in these traders that were doing well for themselves. So it was at times difficult to, enforce regulation and the regulatory piece. Walked over to Schwab and they didn't know what to do with me. They very quickly threw me in to make me a senior broker with Schwab. So on the fanciest team. I was on the Platinum or Pinnacle team, if there's any Schwabies on the phone or on the line. And I was surrounded by 60-year-olds in my 20s. And I actually was teaching some of these 60-year-olds how to trade and read tape, believe it or not. Wow. You'd think that, you get this gray-haired senior broker at Schwab, you think that they would know something. Some of these guys were hired directly out of college to go work for Schwab. And it's just interesting. It was eye-opening for me to see, these individuals didn't know how to read NASDAQ level 2 data or interpret the market makers. So it's kind of fun to, be the smartest guy in the room, especially the people around me had gray hairs. That was kind of fun experience. Towards the latter part of my time at Schwab, I was on the institutional desk working with advisors, helping them with their practice, teaching, working, helping them with trades, so on and so forth. Nice. Eventually became an advisor. Then I ended up running advisors for a firm called SagePoint. I had 150 underneath me that I was supposed to oversee. I guess I was a district manager. I had a fancy title, but all intents and purposes, I guess I was a district manager over a bunch of financial advisors. So I'm kind of a fun, interesting cat because I've had the short-term, fast-paced day trading background, running a trading floor and being a day trader, as well as the advisory side as well. So there hasn't been a whole lot that I've not come across over the years. As far as me, as far as what I like to trade, and I've traditionally been a hardcore stock jockey. Day trading stocks back in the day. I enjoy options, and I also enjoy futures occasionally too. And I oftentimes mash all three together depending on my mood. Okay.
Yeah, I should probably say, it's kind of funny. I should make the disclaimer. Sean is happily married because it almost sounds like you're doing a Tinder profile there. It's like, I enjoy long walks on the beach. I trade this asset. I enjoy options. Bottom line is a ton of experience out there. And what I like about it is you've seen the institutional side. You've seen the back end side. You've seen the retail side. So you offer a unique perspective on the market. So with that, I'm going to try to dive into some of the topics today. Before the show, I was running through going, hey, what topics are of interest to you, Sean? He goes, one of the things that comes up in his class, and we'll talk about his class here in a little bit, is this concept of spread differential, which I think many people probably don't even know what that is. So let's start talking about spread differential and why you think this could be a great component for anybody who's interested in options.
This was something that came across or came up quite a bit when I would travel to a various center. They corner me, in a hallway somewhere or in a back classroom somewhere and say, Sean, how wide? How wide do I make my spread? And so it sounds fancy saying spread differential, but it depends on the circumstances. There's three pieces that go into it. There's the insurance piece, there is the risk profile within the spread, and there's also the profitability that you're trying to achieve, or I also affectionately call it net delta on the spread. And so depending on the ticker, depending on the circumstances, you need to kind of walk through on how wide to make a spread. Me personally, sometimes I do a 3 wide, sometimes I do a 15 wide. Just depends on my mood, the ticker. And a lot of people misconstrue spreads. And I find, working with people trying to trade spreads over the years is sometimes people have the heebie-jeebies. Not to downplay risk, but when you put on a spread, more often than not, it's a defined risk trade. And so, maybe I'm facetious, but to me, it's like, if you don't like the defined risk on it, do a tighter spread.
Mm-hmm.
And so to me, it's not just, static. And so, I have a fun class, a signature series class now called Pedal for Premium. And it's not only about efficiencies of premium, but also, how to fine tune, how wide to make a spread. Mm-hmm. And, to me, sometimes people just don't run and model it out. And so I'm a big fan of back testing and profiling different spread widths per ticker. I don't know. That's the nutshell of it.
Yeah, no, I like it. I mean, and I think that it might be a little bit challenging for people who aren't into the option space, talking about a 3 wide versus a 15 wide. And I think the bottom line is, especially if you are doing spread trades, to analyze exactly what that risk is to you. And with all securities, whether you're trading Forex, futures, options, even cryptocurrencies, there's a spread between the bid and the ask prices. That's not the same thing here. This is a spread between the two different strike prices, or the strike prices, depending on which spread you're using. And that is what Sean's basing this off of. So I wanted to kind of maybe explain that there's a difference between what the word spread means and how it's utilized here, because I think it's slightly different.
Absolutely. And I guess sometimes the way for a newer option person to understand what a spread is, think of it as a single-legged option with an insurance leg attached. And that's all we're kind of talking about is, how close to make your insurance, how wide to make your insurance on the single-legged option. Mm-hmm. So that's kind of a fun way to think about an option spread.
And I think the challenge here is, when you think of insurance, a lot of people say, well, I want to have the best coverage possible. Okay, well, that's probably going to cost you a bit more. And with everything, when we talk about any asset class, there's those elements of entry, stop loss, price target. And that makes it much simpler because your stop is very clear and easy to see. With options now, you're doing a couple other additional steps here, right? So if you're buying an option, you have defined risk, and that's the premium you paid. But now you're also using another option to maybe even reduce that risk a little bit further, and that's your insurance, correct?
Absolutely. And sometimes, we put insurance on an option leg, and it's too tight. So sometimes you're so worried about protecting, or CYA, as I affectionately like to call it, to where there's not enough what I like to call meat on the bone. Right. Where there's not enough potential for profitability. And there's such thing as having too good of a coverage, so it's a balance between, can you sleep at night versus having a chance of having the trade, price per ounce, like if you're shopping in the grocery store, to make sure that it has a good performance as well. So it's a balance between how much you're willing to lose on the trade versus how much profitability if the trade starts to work in your favor.
With your style of trading, do you have a fixed set of options that you look at? For example, there's some people who've come in this program that they're just trading the SPX. They could care about anything else. I know other people who their primary focus is earnings season. Here we are now in earnings season. They're loving it because you get tremendous volatility, inflated premiums. There's some people that may look at just a specific basket of, let's say, ETFs because of liquidity, and they'll trade those options. How would you define or explain your style with regards to selection of what it is that you're looking for those options trades?
Absolutely. It's a little bit of a weighted question because the answer is it depends. And so let's compartmentalize it. Like in my retirement account, I actually do ETFs, but in conjunction with individual stocks. And so I do some kind of Bill O'Neill or Buffett-esque type fundamental scanning and then I'll implement option strategies on individual tickers. So I guess I do trade individual tickers or options on them inside my retirement account, but I'm going to do some not traditional fundamentals, but more kind of Buffett-esque or value investing fundamentals on a basket of tickers that I'll continually trade over and over again.
Mm-hmm.
So I guess in my retirement, there's some ETFs and some individual stocks. Now, if we talk about my shorter term spread trading and more kind of weekly option account, dominantly, I just like individual stocks. Now, I do trade kind of a core group of about, I'd say 15 that I just kind of trade over and over and over again that I have over the years. So I'm a big proponent of stranger danger. And so, for me, even in that 3-day class, I built in scanning because a lot of people don't know how to do volatility scanning to come up with a core group to start with. So I personally don't mind individual tickers, especially since I'm a stock jockey background that I come from. Then I'm going to kind of have a core group that I am familiar with that I trade over and over again.
When you develop that, and I think that's legacy stuff that you and I are used to from the old trading floor days, where you were just you'd find a couple key things to trade and just focus on those. Do you find that you gravitate towards a specific sector? For example, I gravitate away from specific sectors like biotech and pharmaceuticals. That's a sector I'm just like, nope, can't do it. Do you have a personal preference that you gravitate towards?
Absolutely. Same thing. I don't do drugs is the proverbial joke. No biotechs. To me, pharmaceuticals. I might trade Pfizer, but I probably haven't traded in a couple years. But normally energy, like normally my go-to, little tech, a little bit of energy are kind of my go-to. Occasionally banking and retail. So I guess those are the four. So banking, retail, tech, and a little bit of energy. So oil.
It's been a good one recently. Let me go. Let's see here. I'm going to read a question from Tom here. And again, if you guys have questions, now's the time to ask them. Feel free to send them on in. Just give me some question marks at the beginning so I can figure out what has been asked directly to Sean or myself. But I'll read this question here from Tom, who's with us today. He had a few. Obviously, he said he's taken some classes with you. He loves the way that you chart premium, which is something that a lot of people don't do. He had a question that said, I'd also like to know his favorite way to get out of a position. Corey Lane showed us how to use the underlying conditions to trigger selling the combination at ask plus 15, which is a lot better than getting out with a market order. So what would you say is your preferred way of getting out?
Okay, let's start with that. I know Merlin and I probably are very similar, where a market order is kind of like a plague to us. That comes from being on a day trading floor, to where if you send a market order at a New York specialist, he would just clobber you on the bid and ask spread, difference between the bid and the ask. And so I'm a hardcore like limit order trader. And so I am right there in that same kind of perspective, is that I do not like sending market orders or setting up a trigger off your underlying to do a market order on an option, because options are less liquid than equities and options have wider spreads. So therefore, if you send market orders, you can oftentimes get clobbered. So the way to fix it more often than not is to do limit order style trading. And so for me, exiting out of a trade, what I like to show my students is the moment you get in, you can actually have a predefined conservative target on your premium, and then just a plain old limit order, even on the net spread premium. And so to me, that's my personal preference, is just to put in a conservative limit order exit for my premium. And I've been that way for, I don't know, over 10 years, I guess. I don't know, long time. That's my personal preference. And another thing, just as a side note, so some of my companion sessions I've been doing, a lot of students are starting to implement alerts. And so you don't necessarily have to get out. Can you just be notified when a particular premium gets to a certain point for either exit or for actually entry? And so I'm a big advocate of that, and I actually built it into my curriculum recently, mainly from a core group in Scottsdale. They're really big on alerts off spread premiums, which is kind of fun. You could use that for entries or exits.
I think alerts are probably one of the more underutilized tools that's available to every trader out there. And some of you might be with platforms that don't offer alerts. I would probably suggest going with a platform that does offer alerts. And I've always been a big fan of it, because if you are somebody who doesn't want to sit in front of the screen all day long, I can go and map out setups. And regardless of what instrument it is, if it's stocks, Forex, futures, even cryptocurrencies, you can set alerts on price charts. Say, hey, you know what? Notify me when this security gets to this price. Then I'll I'll look at it, evaluate it, maybe make a trade off it. Especially if you're opening a new position or potentially looking to exit one. I think alerts are something that we should all be using. They're pretty critical.
Absolutely. And if you want me to answer the first part of that, is just I like to, call it several things. I have a fun class now called Pedal for Premium. To me, it's learning efficiencies with premium. And so that's kind of a tagline, I guess you'd say. To me, it's learning how to be more efficient with your premium. It's funny how sometimes students ask me, is there a book out there somewhere that I could find to teach me how to time when premiums are the most advantageous to jump in? Now, it works both ways. It works both ways on the credit side as well as the debit side, buying options or selling options. If you're buying options, you want cheaper premiums. If you're selling options, you want more expensive premiums. And what's interesting is, I haven't come across a book that quantifies, is this a good premium or is this a bad premium right now? Because most option books that I've come across over the years just talk about, hey, you pull up the option chain, there's some premium that's good enough for you, you just jump in. Mm-hmm. And so the old school expression is Vega. And so the traders that I haven't come across any books, but I have come across other traders, and usually they're the Chicago pit traders, and their expression is, it's all about the Vega, man. It's all about the Vega. So they're going to use option Greeks to help them when to get in or when they think premium is advantageous. To me, when you chart premium, even chart a spread premium, makes it much more visual. And not to say that my method's, better. It's just, I think it makes it more user-friendly. And so, there's some concepts, and I show people how to do that. I also show people how to time what I call volatility, or time your premium when you're jumping in or getting out.
Nice. Question from Richard. He says, Sean, do you use any fundamentals when establishing a position? I think you briefly mentioned that, we're doing more of a O'Neill, Buffett type of approach. But what sort of things are you looking for? Because when you're looking at fundamentals, obviously that's generally for the long-term play here. Well, what are you looking for?
So that's important to remember. And remember, I started the conversation off saying, I do individual equities, but I do it more in my retirement account. And if I do that, I'm going to bring in some fundamentals. And I slower paced option trade in my retirement accounts, and I might not be holding a position for 6 months or, a year or two. Mm-hmm. It just depends on the circumstance. If I've, gotten the yield that I'm looking for, hit my target or not. But for me, I don't per se do fundamental scanning for shorter term weekly trading. It's not necessary. But the fundamentals that I, look for stocks that I may participate with in my retirement account, yeah, I do bring in some fundamentals, and they're more value investing fundamentals, not per se the fundamentals that you learn in like business school or having an economics major. It's more Benjamin Graham, which is the gentleman that taught Buffett. And a couple of the cheat codes are finding a company that makes money at an increasing rate year on year for a 5-year outlay. That's just one of the premises. And I think I read that, 15 years ago. I think I picked that up in his daughter wrote a book. And so he's not the only one. Bill O'Neill does something similar. Same thing with Benjamin Graham. So they're not going to mess with a stock unless they make money at an increasing rate. Okay, that's one of the puzzle pieces. The other puzzle piece is a screaming deal on the share price. So also known as P/E ratio. So it's not if it's a $5 stock, not if it's a $300 stock, but finding a stock that is cheap relative to the earnings coming in the door. And so if you combine getting a company with a low P/E ratio with a company that makes money at an increasing rate, combine those two pieces, all of a sudden you're finding tickers that are not only in Buffett's portfolio or that are on his radar, believe it or not. So that's kind of, and I actually show these things, and I teach students how to scan for this. And I built this into that also in that class that I'm doing now, just because per popular request. And so some of the things I wanted to show my students, some of the things it's been a culmination of things that students want to hear more about. Mm-hmm. And so those are some of the fundamentals that I personally look for if I'm going to trade a stock a little bit slower paced, like in a retirement account.
Nice. Like it. I was going to go into the conversation about, how on earth are you finding stuff right now that's relatively cheap? Because right now everything seems to be very expensive in PE ratios. But looking at my clock, we have like 4 minutes left, so I want to make sure I get to more pressing things than that.
Absolutely.
You've been doing this a long time in a lot of different asset classes. Options for many is probably the most challenging and confusing because of not only the nomenclature, but all the different strategies and tactics. If you had to I guess, give one piece of advice to somebody who's starting out or looking to start out in options, what would it be?
It's funny. I kept, so I can give you the abridged version, but for me, when I was trying to cut my teeth, as far as trying to generate or create an option system that I could consistently generate revenue at home with, or personal trading options, because I traded some industry options prior to me actually doing them for myself. Okay, I had to do and create synthetic longs, okay, back in the day.
Learn with someone else's money, right?
Right, exactly. Yeah, I was creating synthetic longs so we could short on downticks, and I had to be a principal to be able to do that. But I didn't feel I could trade options at home for revenue, okay? And I kept buying more option books. I didn't feel any smarter by buying another option book. So for me, I actually had to go do it. And so to me, we can talk about throwing a Frisbee, all you want, but until you throw that Frisbee, then it'll become more intuitive. And so for me, just being in some simulated trades, and for me, it wasn't simulated, it was live trades, finally made the glue kind of stick for me. And actually the SIBO, believe it or not, my first, just to where I felt somewhat of a centering was on the SIBO, on the education tab. That's the honest truth, Merlin. That's actually where, I felt more comfort. And I already purchased like 4 or 5 option books, and they were kindling at this point for me, because I couldn't just, maybe I'm not the brightest bulb in the Christmas tree, but like, oh my goodness. And so I found more comfort actually on the SIBO, on the education tab, right, and then just put on some trades to get started.
Right.
Now, granted, I went through probably a 3-year journey to get centered on specifically what strategies work for me. But yeah, you don't need to. You got the academy, and you got cool classes, and like pedal for premium, like my class.
Pedal for premium.
I can hopefully ramp you faster. Anyway.
And that's the ultimate goal. Yeah, Brendan says stable income credit spreads. Well, for many it is.
Absolutely. There's nothing wrong with that. It's part of my arsenal.
Yeah. All right. So Big Eb, and this is a topic that's really, I guess they want to know about every guest that comes on the program. And then you and I were in a position back in the late 90s where we witnessed a revolution where it went direct access trading, so's bandits, and it fundamentally changed the way that retail people interact with the markets. Then there was the internet, that was the dot-com bubble back then, and now all of a sudden we're in a unique situation as well where it seems like we're on the precipice of a whole change in the fundamental way that we live our lives with digital assets. So Big Eb's question is, what's Sean's opinion on digital assets? Things like Bitcoin, Ethereum, Litecoin, all these different new cryptocurrency type stuff.
To me, I'm all for it. The rebel in me likes the whole kind of idea of it. And to me, taking some of that control away from the government, especially through COVID. I'm sure some of you were eye-opened where, the things the government did in result of COVID. And we weren't the only country. Like many countries were doing the same thing. But I like the concept of cryptocurrency. And to me, I think the only hurdle would just be government intervention. And if you recall, the United States probably 3 years ago, and maybe Merlin could chime more in. He's more of a, more in the know than me. But the United States was complaining about Bitcoin for like a year and a half, and all of a sudden the United States quit complaining. So either they found a way to track it or control it. I mean, I don't know, and maybe I'm conspiracy theory on it. So to me, as long as there's not big government intervention, I think it's here to stay. Personally, I don't know if that's what you wanted from me, but
no, I think people are just really curious to get different perspectives, because I believe personally that there is this legacy opinion, and there are some people that still think that it's a huge scam, and
nope.
I think that some digital programs are going to be scammed, but I think digitizing the way that we do things, it just seems to make sense. Look, if you were to say our CDs outdated, or MP3s, or, oh God, no one's going to use MP3s, digitizing music was obviously one of the best things ever, because I can now have 70,000 songs on my phone. It's a little bit easier than carrying around, 30,000 records in crates. So to me, technology is the big change.
And I think it's here to stay as long as governments don't get in the way, because they're scared of it. They're terrified, because then, if you take the country's currency value away or take the strength of it, then it freaks out a country, right? So to me, as long as, there's a balance between government and, digital currency, I think that it'll, for sure here to stay. I think it's out of the bag. It's here for good, in my opinion.
I agree. All right, Sean, when's your next pedaling for premium class? Because I'm right on time, so perfect time for us to round it up.
It is this month, and it's Friday, Saturday, Sunday. So it's the 23rd, 24th, and 25th. And if you're interested, just check with your center on all the details. It's called Pedal for Premium is the name of the course.
Nice. I'm bringing it up right now on the side monitor over here. For those of you who are on the Trading Academy, you can go to your Myota page. You can see here, he just looks like he's... Here's his Pedal for Premium Signature Series. This is all the stuff that Sean is doing. So if you want to take other courses with him, you'll see all this stuff that's available. But that's the easiest way. When you guys see Online Trading Academy instructors on here, you just go to Myota, type in their name under the calendar, it'll tell you everything that's going on and when they are when they're presenting. Awesome. Hey, man. Well, I know it's been a challenge getting you on because we're in different parts of the world and you are very, very busy. But I appreciate you taking some time to join us today, give us a little insights into your options experience and your background. So thank you so much. Hope you guys have a fantastic Pine Car Derby this weekend.
Yeah, no, it's here comes the crazy. So now this is actually the calm part. So I have prepared this afternoon, and then tomorrow's just probably 100 people at my place tomorrow. So
wow.
Anyway, busy.
Don't tell the health department, but that's okay.
I know. Yeah.
Awesome, man. Hey, well, thank you so much. I hope you win tomorrow.
All right, cheers. Sounds good. All right, take care, brother.
Guys, that was Sean Reed. Let me end this call here real quick. That was Sean Reed. I wanted to get him on longer, but very limited time. 25 minutes is all we could get with him today, but hopefully you enjoyed him. I know that some of you have taken classes with him. Just a great guy. It's what I love about, and this is one of the things that drew me to Online Trading Academy to begin with, was the diversity of background of the instructors, where some places that I was looking at when I first looked at classes, and mind you, when I first took classes, it was 1998. I actually drove down to Southern California to take a class with Online Trading Academy, but that wasn't because it was the only one. I looked around at different places. There was a school in Dallas, there was a school in New York, a couple in New York City, and ultimately I went with OTA. But part of the thing was there was multiple people there to learn from. It wasn't just one guy. And over the years, that stable of instructors had grown significantly. So when, Sean isn't somebody that I met through my circle of trading friends. I actually met him through OTA, and then you hang out with these guys and you start to learn more about their style, unique perspectives, and I think that a lot of you kind of are appreciating that, where you might take an options class with somebody like Corey Lane, and then maybe take a class with somebody like Tim Blotzer, and then take a class with somebody like Sean Reed, and while they're all going to be mainly preaching the same money management, same risk management, because that's the only way to really make it in this industry is if you are a good risk manager and don't have big losses. But then you see the different styles that they implement. And Sean has always impressed me with how even-keeled he is. He's always just seems to be very, very calm, very level-headed, doesn't really get emotional about things, and that's because the trades that he's in don't let him get emotional. It's all very structured for him and just matter-of-fact doing business. So I think that's pretty awesome. So anyway, hope you enjoyed that one. Again, if you want to know more information, you can contact your local Online Trading Academy, or you can just go to your Myota and see when his upcoming classes are. All right, what else do I have here? Merlin, was there a bunch of fear, uncertainty, and doubt? Yes. Okay, so let's talk about that briefly. It's a great question or comment. Was there part of the reason we have digital assets, if you look at the white paper by Satoshi Nakamoto, whoever that may be, if you look at that white paper, that was a retaliation to a systemic problem, a failure of the financial system to adequately allow the retail people to access their money and move it around. So that's what Bitcoin was initially intended to be. It won't be that going forward. I don't think it's going to be the payment system. However, it started that digital asset revolution. So to me, it was coming out of necessity, where it's like, screw you big banks. You guys are hoarding all the money, making all the money off of us. I just want to send Brendan $50. I should be able to do that without having to go through you, and you're using my money and all that. So it was a result of an inefficiency or a problem in the markets. If you go back into the early, or I guess you could go late 80s, early 90s, it was very similar. The spreads, and again, different than the spread differential that Sean talked about, but the spreads back in the late 80s were extremely wide. We're talking $1 or $2. So meaning if you did a market order through your broker, you're going to pay probably $1 minimum, maybe even higher than that, than the normal price. Why? Because the market makers had free reign. Nobody else could compete with them. They had a monopoly on that. So at that point, to be a market maker in the late 80s was epic. I mean, you just had the license to print money there. Any market order that came in, you just go, I just made a bunch of money for free. Give me a 50,000 share order. I can add $1 to each one of those. I make 50 grand. Wipe my hands. My day's done. I'll come back tomorrow and do it again. So all of a sudden, Harvey Houtkin and a couple others, that's a famous name in the industry, Harvey Houtkin, basically says, hey, this is crap. I should be able to go directly to the exchanges with my orders because I'm calling up my broker trying to buy something or sell something, and they're not even responding to their phones. I got to leave a voicemail, and 30 minutes later he calls me back, and then I place my order with him on the phone, and maybe a couple hours later my order's executed. That's inefficient marketplace. I can't have that. So this rule came, which was called SOS, Small Order Execution System. You might have heard something called the SOS Bandits. Now, SOS Bandits were basically those that took advantage of a new rule which allowed you to send a 1,000 share order or less directly to the market maker and get executed. So basically now the market makers were on the hook for 1,000 shares or less, right? So what happened is now retail traders had a little bit of an in, not an edge, but an in to the market. From there, the rules changed even more, and there was legislation, there was all kinds of lawsuits. It basically says, hey, market makers can use these electronic networks called ECNs. They were using Instinet, and that allowed them to buy and sell. And it's like, wait a minute, why can't we as retail traders do that? So I want to say it was the mid to late 90s, the rules changed on order routing, which allowed us to interact with electronic communication networks. It was called ECNs. That whole industry was called direct access trading, meaning I no longer need to go through a market maker. I can go straight through the exchange and I can negotiate my own price. As soon as that competition came in, what do you think happened to spreads? The spreads went from well over $1, because when I started, Microsoft spread was at least $1. I could sit on the bid, buy 1,000 shares, flip it on the ask, make $1 on 1,000 shares. I made $1,000. Like that. It would happen all day long. Now, granted, I took some losses too, but to just show how easy that was, it was these big wide spreads. With that competition, those spreads started to shrink because no longer am I going to look at a $1 spread. As a retail trader, I'm going to cut in there and shave it by a 16th. So now all of a sudden the spread is 15/16. And then somebody comes in on the bid side, and now it's 7/8. So it started to shrink those spreads and take profit away from the institution. Was there FUD, fear, uncertainty, and doubt? Yes, there was. And the fear, uncertainty, and doubt came from the institutions. The institutions had a monopoly on this. So what were they saying to their clients? Don't do direct access trading. It's dangerous. You'll lose all your money. It's a scam. Interesting. Exact same words are being said about cryptocurrency in 2014, 15, 16, 17, and even still today. Don't put your money into it. Don't use it. It's a scam. So yes, these systems arise out of necessity for direct access trading, which is what opened the door for every one of us watching this today, regardless of who you are. Direct access trading is what allows you to really manage your own orders and send directly to markets. That was because the institutions had a monopoly on something and they were screwing the public. Digital assets are a very similar case, right? Banks have all the control of the money. All these centralized entities have control over data and information, and they are doing what? Making tons of money on it and screwing the public. So we are seeing the digital asset transformation, and to me, I don't see it going back anytime soon. As I mentioned yesterday or on Wednesday, I think that the huge validator of this industry just happened on Wednesday with Coinbase's IPO. That is a major step in legitimacy and adoption of crypto assets. So we'll still see lots of volatility, but now I think it's going to get much more mainstream. So anyway, there you go. That was a long-winded answer, Brendan, to your question there. So hopefully I answered that one. You drove from Southern California. I drove to Southern California from Northern California. I grew up in the Bay Area, north of San Francisco. So you talk about hippies. My name's Merlin. I mean, my parents got to be hippies, right? What else do I see here? I think crypto is going much higher. I do too. The challenge here, as I showed you guys the other day, a list of the ecosystem for Ethereum and all the different projects on it. It will be like the .com bubble, but in this case, what you're seeing is not just one area, which was .com. You're seeing DeFi, which has so many different fragmented sections in it. Within each one of those, we will have a leader. Within each one, what flew by your head, Walter? Let me know. within each one of those sectors, whether that's lending, whether that's derivatives, whether that's insurance, whether it's custody, oracles, things like that, there will be one or two major players that evolve out of that. And I think for me anyway, right now, I want to make sure I'm doing my best to find out what those are and put some assets into those, because I agree with Brendan. I think the whole space will go much higher. If you just look at the trend, guys, in 15 years, everything will be digital. It'll all be digital. This device will be the most powerful device you have is your phone. It'll connect you to every single thing and allow you to manage every aspect of it. All right, what else do I got? Cryptos will be a player, but will become centralized for the most part. Sadly, yes. They will continue to. There'll be some stuff that's pushed to be centralized, but you'll get this group of rebels, the Luke Skywalkers, the rebel force that's going to stand up to the dark side and say, no, we're not going to give in. And ultimately, I think the retail guys will win at the end. Brendan, so no wonder that shows are always exciting for you. No potency in your edibles, huh? All right, let me see if I have some listener questions here. I had a couple that came through, and I'm not sure if I didn't write those down. Dab nabbit. There were some good ones I wanted to make sure I got a chance to get to on today's show, but unfortunately, I think I might actually miss those ones. So, again, if you have questions here, let me know. Send them on in. I'll try to get to them, but I'm going to go to the email real quick because there were some good questions that came through that I didn't get a chance to get to. Let's see. This one's for Michael. Michael just sent this one in a little bit ago. He says, is the SPY in a spinning top formation, and is it significant if the other indexes do not show similar patterns? All right, so a spinning top formation is really simple way to look at it is it just represents indecision. Had a little up, a little down, but ultimately really didn't change much. That's a sign of indecision, and normally it's hesitation. So if something has a real strong rally and you get that hesitation moment, all that means, it doesn't mean it's going up, doesn't mean that it's going down. I mean, we know it's going to go one of those two directions eventually. It's basically saying wait and see. So if something has a huge rally and a spinning top, don't just short it because you think it's going to go down. Really, you want to wait for confirmation, right? So it's about mapping out the highs and lows there and letting the market do what it has to do. So to that end, I will bring up a chart of the SPY. I'll do SPY as opposed to SPX or the ES. Stick with ETFs. This is the SPY, which is the ETF for the S&P 500. Let me get rid of some of these lines here. I don't even know what these lines are for. I think it's someone who's selling some puts. This is your spinning top, and it's way up at the top. It's after an accelerated move. Is this a sign of weakness? A little bit. It really just means there wasn't a lot of conviction to push it one way or another. So the simplest and safest thing to do would be to come through here, take your drawing tool, whatever platform it is that you're using, and map out those highs and lows and say, okay, I'll just wait for it. So on Monday, when this opens up, I'm just going to wait for it to break above or break below those before I make a decision, either bullish or bearish. I think we would all agree that the markets probably need a breather, a little bit of a break at this point, especially the S&P. When you look at what the S&P did this week, it's been pretty phenomenal. I mean, you've had 4 or 5 trading sessions, and only one of those was down, and it wasn't really that bad, but we've had some big up days. Now, if you look at the NASDAQ, that down day we saw on Wednesday, a bit more jagged, but still, all in all, a nice up week for it. Now, when you start to see these, what do they call these? Tweezer tops. A tweezer top would be, you got, big candles, small, big green, big red, big green. That's a tweezer top. That's, again, people view that as a reversal formation, but I don't put any emphasis on those formations. Russell 2000. Obviously, the dog of the week, it was still up, had a great week, but it was nowhere near what the other markets did. So when you look at the S&P 500, it's the lead dog right now. I don't bring up the Dow here. I could if we wanted to, but the Dow all-time highs as well. So those are your two leaders out there. I would just be a little bit careful if you're thinking about going short or using that candle formation. Really wait for it to tell you what it wants to do as opposed to you telling it what you want it to do. Okay, let's see. Can you teach class? What class do you want me to teach? Merlin, do you think that AAM auto market makers will be game changers for the markets in regards to liquidity issues? Yes, I do. I'm not going to take the time to go in depth on what AAM is, or AMM, excuse me. This has a lot to do with liquidity pools and automating the market maker process. Right now, the market makers act as a gateway to a centralized medium, meaning the market makers are really the ones who are providing liquidity to a marketplace that I want to say is controlled or manipulated, but a market maker's job is to be a buyer and a seller at all times. So if the market goes to hell in a handbasket and crashes, a market maker's job is to stand there and say, I'll buy some, I'll buy some, I'll buy some as it's falling. Now, we all know that they're not going to buy a lot because they don't want to, put themselves in harm's way, but they do provide liquidity to a market. With automatic market makers, you're dealing with liquidity pools, which is a different ballgame. And yes, I think right now I believe it's in a test phase to see if these liquidity pools and automatic market makers structures work. And so far it seems like they are, but I think they're not being used on mainstream exchanges. It's predominantly digital asset exchanges. So that's something that we'll see going forward. But yes, I definitely think it's a good one. I've got no class. Yeah, leave it to the guy who's out there watching my show. Whatever, Brandon. Brandon, sorry. What else did I want to get to? So that was a good question that came through about the candles and spinning tops. Now, if one market has a spinning top formation, the others don't, I don't put too much emphasis on it. I don't want to put too much weight on a spinning top formation. It just gives me a little bit of an insight. It's like, you know what? It feels like it just doesn't have the oomph or the thrust that it did before. But I mean, if you look at the S&P futures, look how many spinning tops you see here. I mean, there's a double spinning top right there. There's one right here. I mean, you can make an argument that these are all spinning tops, and it's done nothing but go up. So, put those lines above and below it and wait for that breakout one way or another and trade off of that. To me, it's probably the best one. Actually, Patrick says, I know Merlin likes small time frames. I saw his chart one day, and he didn't clean it up. Like 50 trades. No. I don't do 50 trades. There's no way. I don't know who you were looking at, but I do not do 50 trades anymore. I won't even do 50 trades a week now. I'm much more selective. So no, I love small time frames, but I also really love big time frames. Big time frames tell you where it's coming from. I've mentioned this before. I've known traders who will trade off of one chart and one chart only. I think you're a fool if you just look at one picture of something. If you look at let's say you trade off a 5-minute chart and you're not looking at the hourly or the 4-hour or the daily to see where this thing has come from, you're fooling yourself. You're really putting yourself at risk. I'm always looking at multiple time frames, and my favorite, just to correct you, Patrick, my favorite, daily. I love the daily charts. I start every day, every night with analysis on daily charts. I want to know where the big picture is, and for me, daily is the big picture. If I want, I can zoom out real quick and check a weekly or a monthly, but the daily is really my favorite one, because what that allows me to do is allows me to look at any long-term investments I might want to make and say, okay, how is this setting up? And then if I see a good pattern, a formation, a setup on the daily, I can whittle that down into smaller time frames, 4-hour, hourly, 15, 5, and see, is there an area where I might want to do some short-term trades off of this, knowing that the big picture might be turning or coming into an area of demand. So there you go. So neater. Ideally, 5-to-1 is better than 1-to-1, more skewed towards returns. We all want 300-to-1 reward risk ratios, don't we, Brendan? I mean, that's obviously what everyone would want to have. Okay, let me, I did not update everything, so I'm going to see if I can just slap this on the screen here. This is the more important piece that happened today. Earnings season kicked off this week, and it's been great so far. I'm really curious to see, though, if this bar has been set so high that other companies might struggle going forward. Right now, things are looking pretty darn good. We had real good information with earnings. Here is the results for today. Morgan Stanley, blowout earnings, and it was down. I mean, they beat considerably. They were 50 cents more per share, and they were down 2.8% today for Morgan Stanley. On the banking side, you also had great earnings from Bank of New York, right? It was up. They beat by 11%, yet they were down 4%. State Street also beat earnings, and they were down 7%. So I think what's happening, we saw Wells Fargo, JP Morgan, and Goldman Sachs report on Wednesday, all posting phenomenal numbers, and two of those did really well. For me, this is a little concerning just because you're seeing great numbers. I mean, look at these percentage beats here where it says percent surprise. Everybody beat today. I mean, Ally Financial just smoked it, yet they're only up 0.21%. I mean, they almost doubled earnings expectations. That's phenomenal going forward. So even though we're seeing rising rates, which historically banks like that because they'll make more money off the loans, it seems like it's slowing down a little bit, or at least the expectations are, because why weren't people out there buying today looking for more upside movement? All right, what do I got? Drinking and chatting is dangerous. I'm doing good. Look, I'm still on my first glass, guys. No driving and drinking. So there you go. Okay. Now for tomorrow, since I did not get this one up, I will see if I can bring up the page. I don't know where I got so many damn screens going on here today. Monday actually was a good day for earnings. I'm trying to do this off the top of my head to remember who actually has earnings on Monday. Oh, come on. It was some decent names, but it's not all concentrated like it was this week. This week was pretty much financials. On Monday, I believe, if I'm not mistaken, we're going to be looking at, hold on, I got to look at it right now. Oh yeah, how could I forget? IBM, Coca-Cola, Steel Dynamics, Zion Bancorp. And what's interesting will be the airlines next week. You guys want to keep an eye on those ones because I believe Monday you've got United Airlines, and then I think it's Wednesday or Thursday you've got American and Southwest Airlines reporting earnings. The charts of these airlines companies are starting to look pretty good, and I don't think we'll actually have it in the future where we have an open middle seat anymore. It seems like that's going to be closed off here real soon, or if it hasn't already disappeared yet. Now, that is your earnings calendar piece of information. On the economic front, I'll bring up the calendar here and let you guys take a peek at it. Here's what we have cooking for Monday. Not a lot, especially with regards to the U.S. I'll share that screen. There you go. Especially with regards to the U.S., there's not a lot going on. You can see we've got 0 for the U.S. You do have PPI numbers coming out for Germany. You do have claimant count change and unemployment rate for the U.K., but really not a ton of critical economic data going on for the U.S. All right. As a swing trader, do you keep a weekly, monthly, yearly profit goal? No. And I'll tell you why I stopped doing that. I stopped it years ago. I lose track of numbers, but it was like I set a goal to have like a 40% rate of return. I kept increasing. I was getting better and better and better. I said, I want to have a 40% rate of return this year. And I ended up with like a 33% rate of return, and I felt like a failure. But I beat the markets by a huge margin. And it's like I didn't want to do that to myself anymore. I know it sounds stupid, but I just felt like I didn't hit my target. I felt like a failure, even though 33% was an awesome rate of return to have for the year overall. So I don't set those numbers anymore. I feel like it puts a little bit too much pressure on myself. I just approach each trade and each day the best I can. And if I lose on one day, that's fine. No big deal. I'll go back and do the same thing. And I use the analogy of a baseball player, right? Once they learn their swing, they don't change their swing or do a different grip or do something different. Once they got their swing down and they know it works, you keep swinging. Maybe it's just an off day. Maybe something was in your eye. Maybe the pitcher was just better than you that day. But you're not going to face that same pitcher every day. Go back and keep swinging, and hopefully you'll be all right. So no, I don't put a profit yearly, monthly target goal on it. Remember, my trading plan, it's very simple. The goal I have in there is to take a 2-week trip to someplace I've never been to before and keep expanding my personal well-being with whatever monetary gains I make. So that's it for me. Cool. Let's see. Next week, I actually do have a lot of guests in the program. Let me bring up the calendar because I can't remember. I was booked a whole bunch of people for next week. We will show you in that calendar here in a second. I have on Monday. Let's pop this bad boy out and make it bigger. Ooh, who do we got? For some reason, my calendar is all screwy here. Huh. Great. It doesn't want to show me that one. Perfect. So, next week. We have, someone, I think it was Walter. I think you've been bugging me nonstop. Bring on Jerry Baldwin. Bring on Jerry Baldwin. You know what? Boom! Jerry Baldwin's on the show on Monday. See what you guys get? You ask me. You ask and you shall receive. Jerry Baldwin on Monday. We're going to have Scott McCormick on Tuesday. Sam Evans on Wednesday. Thursday at this point is open. I don't have anybody slated for Thursday, but I do have a lot of stuff I need to get to with regards to past listener questions. That might be a challenge. But we'll probably end up filling that one because honestly, to do and Brendan Wendell, God, the audience has said they never want to see you on the show, Brendan. I don't know what it. No, you're welcome anytime, man. If you want to take that Thursday, you're welcome to it. Bring the dog. That is on the coin. You want to talk about my coin? Maybe I should put a shepherd on my digital asset token, which hopefully I'll have finished by Monday. All right, cool. That's going to do it for me. I'm going to wrap up before I get to 1 hour here. It was a just a tumultuous week, guys. We had some really important things. Again, the crypto kickoff with Coinbase, that was huge. We also have major earnings season starting. That momentum, that heat from earnings season is just going to continue. We'll see if that can continue to propel these markets to all-time highs. We do next week have some interesting fundamental pieces. One thing that I'd keep an eye on for next week would be the dollar index. I know the dollar is critical for many of you in your Forex trades, but you also got to think of it from the impacts on the equity markets. On the big picture, dollar is in a big downtrend. And I agree with Brendan. On the long term, I think that the dollar is probably will disappear. Probably my lifetime will change into something else because we'll have to devalue. But that's going to be way many years down the road. Though the dollar index right now has been on, for the better part of the last few months, has been on a pretty nice uptrend. Higher highs, higher lows. Now, all of a sudden, over the past 2 weeks, it's been an aggressive sell-off, but it's right into an area of demand, so keep an eye on that one for next week. I guess I could probably show you a picture of it, because rather than me to talk about it, why not? I was going to wrap up right there, but here's the dollar sign DXY. You guys can see this 2-week slide, almost 3-week slide. It's been pretty aggressive, but here is the run-up that we've seen, right? It's been a nice run-up since the first of the year. Higher highs, higher lows. If we get below this area right over here, I'll put a little line on it. We get below that. Let's call it 91 and a quarter, 91.30. We could go back and start to test those lows again, because the big picture is downtrend. So this might just have been a pullback up into the downtrend, which is where the probability, most likely it is, just a pullback in a downtrend, which makes a shorting opportunity. But it seems like at a certain point, this dollar will rear its ugly head. Right now, it's still struggling. Cool. Let's see. Yes, it was a great week. I just hope that the crypto markets tank so I can buy back in. I'm disappointed. Man, I watched that Litecoin go today. Holy cow. Litecoin, guys, was just vaulting today. It's like, yeah, I unloaded all my position yesterday. I'm glad to see it rallied about 15% in 2 days, right as I got out. It's okay. Never go upset taking a profit. Alan says, would you say your annualized return is correlated with the amount of time that you spend studying and analyzing? No. Nope. I don't think any correlation. I know this is going to sound awkward to many of you. I do less and less and less analyzing every year. It seems like when I started out, I was buried in every financial source you could find. I was looking at everybody's information. It was just like, it was crazy how much time I spent. I would leave the trading floor, I'd go home, and I would just watch TV or read financials or just look for fundamentals. And the more I do this, the more I realize that I can do less work and get better returns by not paying attention to it all the time. So almost a set and forget or swing trade to position trade type stuff, where I'm not constantly on top of every single piece that moves. Now, that's one of the reasons I like to do this show, to be honest, is because it keeps me in the markets, but I'm not looking at my trades all the time. So no, I don't think that me spending more time would give me better rates of return. I actually think it would probably do worse rates of return at this point for me, because I'm set in my ways. I know what strategies work for me. I'm still learning, but I know what strategies to implement to have more free time for myself. Well, I'm generally not looking at, when you guys sort of come over here, I'm usually not looking at the markets after hours. Occasionally I will sit down with a laptop and flip up the screen if I see some Forex pair that's moving or some nice move in crypto. Yeah, I might jump on it, but I'm doing less and less of that. I'd rather go enjoy some time with my dog and just enjoy life. All right, cheers. Let's see. Rarely are we pulling the opposite direction. Stop selling your crypto. I'm gonna buy back in. I just want the dip. I want to buy the dip. All right, that's going to do it for me, guys. Jerry Baldwin will be on Monday. If you enjoyed the show today with Sean Reed, he's got a ton of information. You can find out more about his signature series by going to Online Trading Academy. If you're a graduate, you click on the Myota tab, type in his name there under the calendar. It'll show you all the stuff that Sean Reed is doing. I think that you guys can appreciate his skill set. He was just, guy knows his stuff, and he's pretty solid at what he does, so I would encourage you to check him out. That'll do it for me. If you have comments, questions, feedback, good, bad, or the ugly, feel free to send it on in at TraderMerlin@gmail.com, which is on your screen. That said, I hope you all have a fantastic weekend. Be safe. Be friendly to your neighbor. God, this violence that's going on in the world is just absolutely crazy right now. Have some fun. Spread some love. I'll see you guys on Monday. Take care.